Section 1. The domino chain. A quiet threat in a loud world. Imagine a single, slender domino standing on a long table. It is perfectly balanced. It represents a promise, a loan, a simple agreement to pay money back at a later date. Now, picture millions of dominoes stretching as far as the eye can see. They form a winding chain across the global economy. Each one represents a mortgage, a corporate bond, a government treasury note. They are all connected. For years, this chain stood silently, letting us build on its stability. But the dominoes are closer together than ever. The line is longer. A single small push somewhere in the world could start an unstoppable chain reaction. This is the debt domino. Simple, and one of the greatest risks to your financial future today. Debt isn't inherently evil. It is a tool, like fire. Used correctly, it powers progress and builds prosperity, helping families buy homes, companies build factories, governments build roads, schools, hospitals. Debt pulls future prosperity into the present. The problem isn't debt itself, it's the scale and the conditions it was created under. For over a decade, borrowing was incredibly cheap. For governments, corporations, individuals, pushing the domino chain to unprecedented lengths. Why should this matter to you on March 8, 2026? Because the world is changing. The era of cheap money is fading into the rearview mirror. Interest rates are rising to fight persistent inflation. Carrying all that debt costs more. Promises made when money was cheap are harder to keep. When promises break at scale, the system starts to crack. Markets, built on confidence, can flip in an instant. This isn't about fear, it's about clarity. Section 2. What is this debt we speak of? At its core, debt is borrowing money you don't have now, with a promise to pay later, with interest. With a mortgage, the bank lends you money to buy a house, repaid monthly with principal and interest. A bond is a loan from investors, interest along the way, principal at maturity. It's foundational to modern finance. 3 components determine risk: principal, interest rate, maturity. The bigger the principal, the bigger the burden. A low rate makes a loan affordable. A high rate can be crushing. Short-term debt is riskier. It must be repaid or rolled over soon. Imagine a company with $100 million due in a year, planning to roll it over with a new loan. If rates shoot up or lenders get nervous, the new loan is expensive or unavailable. A solvent company can be pushed into bankruptcy simply because it can't refinance. That's a liquidity crisis. After years near zero, the world is saturated with debt. Borrowers got used to easy credit. Lenders relaxed standards. A fragile ecosystem formed on the assumption cheap money would last. Inflation forced rate hikes. Every quarter point sends a tremor through the global debt structure. Promises made in one reality must be kept in a harsher one. Understand how debt accumulated. Identify pressure points, see how small sparks trigger big reactions, and build an actionable plan. The goal isn't to predict the first wobble, it's to stand on solid ground, far from the chain reaction. Section 3. The 3 great borrowers: governments, companies, households. To understand the chain, look at who owes the money. 3 main categories with unique risks. Governments issue bonds to fund infrastructure, defense, social programs, and stimulus. Low rates made it seem painless. The risk is confidence. If investors fear non-payment, they sell. Selling pushes prices down and rates up. Widening deficits, scaring more investors, pushing rates higher. Austerity, cuts and tax hikes can cripple growth and fuel unrest. A major sovereign default would be a financial nuclear bomb. Companies borrow to grow, fund operations, even buy back stock. Cheap money drove leverage up. A little leverage amplifies returns. Too much can be fatal. In downturns, sales fall and fixed interest can wipe out profits. Zombies earn just enough to pay interest, never principal, kept alive by cheap credit. Rising rates can end them, triggering waves of bankruptcies. Household debt is personal: mortgages, car loans, student loans, credit card balances. Low rates encourage larger mortgages and finance lifestyles. Payments can balloon as rates rise. Job losses can make any payment impossible. Defaults cause suffering and bank losses, tightening credit for everyone else. Section 4. Triggers on the wire. What pushes the first domino? The line can stand a long time, even as more are added, but it's inherently unstable. In global debt, these pushes are triggers that turn anxiety into crisis. One trigger: rapid, unexpected rate hikes. Variable rate debt and rollovers get pricier for companies and governments. If rates rise faster than expected, many borrowers weaken at once, like turning up gravity on the line. Another trigger: a sudden drop in confidence. Big bank failure, conflict, shocking politics. Investors flee to cash and high-quality bonds. Credit markets can freeze. Or a currency crisis, especially where debts are in dollars, can spiral into default and contagion. Markets have two speeds: slow most of the time, until a trigger flips them fast. Fear spikes. The VIX surges. A safe institution fails. Hidden risks surface. Investors scramble to sort risk from safety. Risky assets are sold indiscriminately and plunge. Safe havens rally. The divergence is stark. Credit spreads widen, a key stress barometer. Liquidity dries up. Spreads explode. Some markets vanish. No reasonable sell price. Leverage forces selling into a falling market, fueling a vicious feedback loop. A debt problem flips markets from calm to panic, until a powerful force, usually a central bank, promises massive intervention to restore order. Section 6. Case Study: The Hypothetical Tale of Innovate Corp. In cheap money years, a mid-sized tech firm borrowed $500 million short-term loans and bonds to acquire and fund R&D. For a while, sales grew. The stock soared. Payments were easy. Then inflation rose. Rates climbed. Variable loan costs surged as sales flattened. A $200 million bond came due. Lenders demanded much higher rates, or walked. With little cash and expensive new debt, the firm was trapped. Drastic measures followed: layoffs, asset sales. The stock plunged 40%. Its bonds collapsed. Lending banks took losses and tightened credit to peers. Fear rippled through the sector. Section 7. Connecting debt, inflation, and interest rates. For a decade, low inflation allowed low rates, which fueled cheap debt and growth, a self-reinforcing cycle. Now inflation forces hikes. Every rate rise raises global debt service, compressing margins across households, companies, governments. Hike too hard, defaults and crisis. Too timid, entrenched inflation. It's a tightrope with little margin for error. Section 8. Building your financial arc. The first rule: do not panic. Have a preset plan. Favor strong balance sheets and steady cash flows. Diversify across assets, geographies, and currencies. Consider high-quality bonds and gold. Maintain dry powder in cash and short-term treasuries for safety and opportunity. 5 steps: review and reduce high-interest debt. Stress test holdings. Diversify broadly. Hold a cash buffer. Stay the course. Avoid headline-driven decisions.